Friends, the topic of today's podcast is what is moving markets? We've seen the markets rising continuously at the index level while sentiment has really not matched up. November was the best month of FII flows with $3.2 billion coming in. In fact, it's the third consecutive month of positive FII flows. So that explains why our markets have been doing very well at the index level. This year, we have seen net inflows from FIIs, and it's reasonable to assume that a lot of this money has gone into the indices, which explains why the indices have done well, because they have the benefit of both domestic SIP savings as well as FII money. But we can't say the same of the small and mid cap and micro cap space. These have virtually not attracted any money from outside. Domestic mutual funds have been sellers in this space, especially in the micro cap space, because a lot of companies post the categorization and reclassification of mutual funds have dropped out of being qualified as stocks which small and mid cap funds can invest into. So many of these companies have become micro caps, and therefore the funds have been forced to reduce the exposure in several of them, and they're just going about selling them unmindful of the fundamentals of the company. So it's been a very painful experience for investors outside of these first 500 companies in the Indian stock market. But we really can't complain, because in 2017 or 18, the companies outside of these top 500 did much better than the top 500. So this concentration has basically reversed that completely. But these things are part of a market journey. I had mentioned that for the last 3 months, FIIs have been net buyers of Indian equity. The fourth month will be December, and it's being a test for us. And knowing the general behavior of FIIs, December is a sign of things to come. So if this month is also a month of positive FII flows, then there is fair reason to believe that this is going to continue into 2020. Needless to say, it's highly dependent on February 1, the next budget date, and the kind of reform we are going to put before the global investment community. If the reform captures the imagination of the global investment community, we're probably going to see far higher flows in 2020 than 2019. I sense that the markets kind of know this, and that is why at the index level we're not seeing much weakness, and we are seeing money flowing into the same set of stocks, keeping them afloat and in fact touching new highs. Now, for this to change, we need a shift or a rotation in investor focus and preference. Now, there is no sign of that now. It's hard to say when that will happen, or even if that will happen in 2020. But from past experience, cycles repeat and market keeps rotating its preferences, and when one part of the market becomes very expensive, it's natural for money to flow into the other parts which are trading very low. It's like almost like gravity. On the debt market side, something very interesting has been happening, because the whole of this year you've had interest rates dropping several times, in fact, and we are not really seeing any sign at the moment of a reversal in the direction of interest rates. So interest rates will be soft. But what we need to really see from a market perspective is the transmission of these cuts increase. We still have a significant amount of transmission to be done, and we have to see how the government ensures that banks pass on lower interest rates to worthy borrowers. and there are enough of people. And once the rates become more reasonable, it's fair to assume that a lot of people will come forward and borrow from the banks. The markets kind of sense that this trend is likely to catch up in the next year. Importantly, from the public sector point of view, the troubles of NCLT and IBC, which they went through right through 2019, are well behind, and we could see that many of these banks are going to receive a lot of bad loans which they have written off. So we'll see all those accounting changes in this quarter and the next quarter. So a lot of things are happening in that space, and we should see a reversal of sentiment in the public sector banks. They're trading at very ordinary valuations, and even a small change in sentiment can really create a serious bump up. It's also likely that the FIIs can actually show interest in the beaten parts of the market, like public sector enterprises, pharma, natural resources, metals. These are all sectors which are completely out of favor, and the category which is completely out of favor, which is your small cap and below, can also see some interest from global investors who are keen to get a long runway into the India growth story. The return of growth is not going to happen immediately. We are going to see a few quarters of consolidation, and probably after that we should see growth come back. This phase is going to be an exciting phase, a very volatile phase. We will see the markets going up at the index level, and we have to see the markets consolidating in the rest of the market. Outside of the top 500 shares, what happens from now is very, very critical for domestic investor sentiment. It's already quite weak, and we need to see some green shoots in that so that people get their hope back. That will bring in a lot of money into the companies outside of the top 500, which will set the stage for a broader market recovery. It's early days, so stay in there, be convinced, and stick to what you believe in. Happy investing.